Well, remember, we were coming off the initial rate cuts, which occurred earlier in that year. We were well over 6%, and we did not start cutting in spite of the sharp contraction in the financial system starting in the summer of 2000. We didn't start moving down until we were sure that the bubble had the dot-com bubble.
Right. Got to define our bubbles here.
True enough, was sufficiently diffused so that we would not risk bringing it back. So we were in the beginnings of that particular type of decline. The problems that we confronted there were strictly operational. There wasn't so much a question of economics at that point. The question was just to make certain that the system breakdown did not upend the intermediation process and the economy. We were beginning to see what subsequently we called mortgage equity withdrawal, which was a wholly novel situation in the size that it began to emerge. And that was feeding into the consumer markets, and you could begin to see the economy begin gradually, but in a non-inflationary manner, beginning to move as the existing home turnovers proliferated. You find that the seller of a home cancels a mortgage which is much smaller than somebody who buys a home, so that the mere turnover of a home raises the net debt on that home. And what all sorts of econometric analysis demonstrated was that equity withdrawal had a significant impact on consumption expenditures. And indeed, I use it as a variable to help forecast motor vehicle sales and other hard goods. But it wasn't until essentially the post-2001 period that the degree of sophistication in the mortgage markets had developed to a point that not only was equity withdrawal occurring as a consequence of the turnover of homes, but also because of basically home equity loans and the whole variety of infrastructure of consumer borrowing that emerged in years later. You must remember that at that time, I and others were basically saying that the presumption that you could incrementally diffuse a bubble was a fantasy. We indeed tried it, not in a materially focused way to diffuse the boom, but we did raise interest rates. And in retrospect, we looked back and said, clearly you cannot diffuse these things unless you hit them right on the head and break the economy, essentially break the potential profitability that is engendering that sort of stuff. So,
you said our extraordinary housing boom cannot continue indefinitely.
Yeah, that was the one. That was 2002, as I now recall. I'm trying to remember these dates.
Oh, believe me, I'm reading it here. November 2002, I believe. That was a private meeting in the Fed, not in public.
No, although I did make a speech around that time saying very much the same thing, namely that there's a housing boom that is developing, and my real concern about it was only discussed with my colleagues. I didn't want to go.
What did you even base that view on? I mean, November 2002, frankly, was before we really saw what ultimately would become incredible.
Well, it really dates back to the fact that I had always been following mortgage equity withdrawal. And you began to see the combination of the savings rate, personal savings rate, declining, and mortgage equity extraction rise. And indeed, from a bookkeeping point of view, it was the rising debt which was subtracting from savings. And you could begin to see the impact of that spilling over into consumer markets. But that was not our purpose. In other words, we were not essentially endeavoring to galvanize the housing market.
Did you not welcome what you saw as the extraction of equity from rising home prices, given its impact on the economy?
Oh, yes. No. And we were aware of, we never fully understood how large that would become.
You didn't?
No, we knew it was there. We knew it was expanding. But remember, we were talking, huge amount of mortgage equity withdrawal at the tail end of this thing, which was far beyond anything anybody I knew would conceivably contemplate, largely because it was not obvious to us that the lenders would be willing to expand the markets as much as they did. And basically, remember that the subprime market, which is just then beginning to evolve, was a very small niche market. And what was a big surprise was it went from 7% of total originations to 20% in 3 years. And all of the housing boom, if you look at housing starts financed by subprime, you can account for virtually all of the housing boom out of subprime finance, and incidentally also all of the reversal. It was remarkable the extent to which this very small niche product, because it became securitized in a vast way and internationally, had a remarkably and certainly in retrospect wholly unforeseen effect. In 2004, there was just no credible information on that. It wasn't until we got well into 2005 that the first inklings that was developing was emerging.
Really? I mean, I find that somewhat hard to believe.
It is hard to believe, but if you go back...
Because these firms, many of which, almost all of which are now out of business, the ones in California, for example, focus solely on subprime.
Absolutely.
They were booming in 2000.
That's right. But
the ads were everywhere. Come refinance, come get us, no money down. I mean... Absolutely.
And indeed, we were acutely aware of all sorts of egregious acts of lending that was going on, but it was still perceived to be a small part of the market. Remember, you're dealing with trillions of dollars, and you tend to look at the ads and you tend to look at what's going on in individual institutions. In perspective, we knew that it was rising, but the whole market was essentially rising. But that would be 20% of originations. Did it maybe got up to 11? Maybe. 20?
Yeah, something we've found out, not a secret, of course, is that so much of subprime was not for purchases, but was for cash-out refinancings. Was for the very thing that you've described, that certainly was helping consumer spending, namely taking equity out. I mean, the game went on for quite some time. You'll refinance, you can put in a pool. We had people kicked out of their houses because they did a subprime to refinance to put in a pool.
Yeah.
It was going on all over the place.
I know, and one of the things that you become very careful about if you're a supervisor or a regulator is be careful of anecdotal evidence as a generic type of indication. In other words, we have a vast country, 300 million people. The amount of economic activity that goes on is just truly awesome. We're dealing with hundreds of billions and trillions of dollars. And it is remarkable how big certain small things look. And so that there's a strong reluctance on the part of regulators not to have anything other than hard data to be looking at.
To homes. Do you dispute that you were not
I was strongly supportive of increasing home ownership, especially amongst minorities, which indeed is where the whole ownership boom occurred. The reason basically is that in a market economy which is based on property rights, it is very critical to have as broad a swath of people who have a vested interest in that system to make it work. So I was very much supportive of expanding home ownership as best we could. Certainly the case that I did at one point make a speech in which I was discussing a Federal Reserve study which indicated that the taking out of an adjustable rate mortgage several years earlier would have saved a significant amount for homeowners, provided that home prices moved in a specific way and interest rates did not. But my main concern about the coverage of this issue about my being sort of rooting on the housing market and all the various products is terribly disturbed by the facts.
You have said things, though. April 8th in 2005, I think you gave a speech at the Federal Reserve System's Community Affairs Research Conference, and I'm going to read here, where once more marginal applicants would simply have been denied credit, lenders are now able to quite efficiently judge the risk posed by individual applicants and to price that risk appropriately. That was April 2005.
That statement is true. The vast majority of those types of loans were doing perfectly fine. And remember here that the reason that the HMDA issue came up and the issue of minority ownership came up is that while it was a questionable conclusion, the data were not all that clear. In my view, that discrimination was going on in a significant manner, was very evident from the statistics, and from the point of view of a banker, I'm saying they were leaving money on the table, and that indeed it was highly desirable to expand mortgages for what effectively became what was not then described as the subprime market. What happened, unfortunately, as I went on, was that the advent of securitization took this little niche product, which I thought was doing rather quite well, and by the end of 2005 began to securitize it at a very rapid pace. Securitization got up to 80% of subprimes late in 2005. Several years earlier, it was at 50%.
Yep.
And if it were not for the securitization, and not for essentially spreading those mortgage backs across the world, the subprime problem would have been constrained to the United States, because I know of no single mortgage that is subprime which is held outside the United States other than in securitized form. If that did not happen, I do think that the subprime mortgage market would have expanded maybe to 11%, maybe to 10% from 7, but never to 20. It would have had, there would have been a problem in the United States because there's a lot of egregious activities that were going on lending, but it was essentially the tremendous demand for these securities by the pension funds, the hedge funds, all of the very sophisticated lending community, which saw effectively subprime MBS coming out at very high rates. And they were sophisticated, in quotes, to realize that that was a very safe security and that the real rate of return was much higher than anybody expected, and they dove in en masse. And the basic problem that they created was they had perceived that basically delinquencies and defaults were very small, as they were in the early stages of the subprime market, because home prices were rising.
And also because the people who were getting the mortgages at that point were still relatively quality
Yes, indeed.
Homeowners, not what would ultimately become people who never should have gotten a mortgage.
As the frenzy reached its peak in 2005 and 2006, what you began to see was such pressure on the securitizers coming from the investment community that they were essentially giving a call to the lenders, in a sense, get somebody to sign a piece of paper and we will take it. Lending standards broke down. They collapsed at that particular point. And all the egregious lending that we now are acutely aware of was beginning to emerge. But we now have evidence of where it was and when. Because remember, we now have data which gives us the default and delinquency experience by vintage of origination. And what you see is that all of a sudden, and I think that we don't have it on a month-by-month basis, but it's apparent that in the second half of 2005 into 2006, the securitization accelerated very rapidly. And a very substantial part of those securities were sold outside of the United States. And that international pressure coming back on the securitizers effectively put pressure in areas where lots of things broke down, mainly in a lot of the fly-by-night operators who got into the position where they got very large, they were rolling the stuff over, there was no scrutiny at all, with the consequence that the paper that was coming out eventually went significantly into default, as indeed we're now seeing mainly in the subprime area. It's also obviously in the Alt-A, but mainly subprime.
Alt-A too. But something else also happened beginning in late 2005 and 2006. Housing prices stopped going up. They started going down, and so the game ended for those who would be refinancing or taking out a mortgage and ultimately hoping they could flip it, and or the increased equity in the home would help them pay for increased mortgage costs.
It actually occurred a little more subtly than that. As the price rise began to flatten, you began to see those responses, because it was the rate of change of prices at that particular and early on which was engendering this extraordinary awareness that this stuff is too easy. We can't get enough of it. The subprime yields are way beyond what they should be. Remember, it wasn't the uninformed consumer who were buying this stuff. These are the best risk managers we have. It was a failure of our best and our brightest, not the problem of investors who were unknowledgeable.
I've talked to a lot of investors. We've gone to some of these places in the world that ended up buying some of these toxic securities. There were very few people, I would argue, in even July of 2007 who fully understand what a CDO was.
I find that bizarre, but one of the interesting aspects of this is there was a great deal of discussion about that there was not enough disclosure about what was in those CDOs, what they were, what their risks were, and the like. The problem was people didn't read it. In other words, it's there. It's called small print, but it's there.
Well, then, the complicity of the rating agencies. People saw a AAA rating on a lot of these securities, and that is all that they felt that they needed.
Yeah.
I've got a higher yielding AAA rated security here that's going to get me a nice spread over treasuries. I'm going to take it as a
Yeah, that's one of the problems when you're when you have investment basically by committee or by intermediary institutions where it's not your money, it's potentially your client's money. But what you need is backup of a verifiable source. And what we have created in this world is an aura around the credit rating agencies about certification from them as the good housekeeping seal of approval. Now, I don't know how deeply you've gotten into how they do that sort of stuff, but I will tell you the record of a lot of the forecasters of ratings have not been distinguished. They never were, but that is true of the forecasting community in general.
It is true.
It is not basically the rating agencies per se.
But they were outmatched. I mean, we have gotten into this a bit, and we have talked to some of the MIT graduates who are at the investment banks structuring these products, and we've talked to some of the people at the rating agencies who were clearly overmatched in their ability, frankly, to compete with the IQ of the people at the investment banks who were far more highly compensated.
We were acutely aware of that fact.
You were?
Of course, because what happens is that clearly the rating agencies cannot afford the type of remuneration that the investment banks and the hedge funds were able to do. And at this particular point, the mathematics of risk management had gotten very sophisticated. And what you needed, basically, to keep up with your competition was risk managers which basically had very great technical capabilities, which created very large awards for them, pay, which the rating agencies which did not have the funds to do that were capable of doing. So as hard as they tried, they were unable to keep up with it. And I think especially in the way the CDOs developed. Remember, we had CDO squared, and we had every sort of complex type of instrument. Now, I remember making a speech at one point. This is in 2005. I mean, I've got some fairly heavy background in mathematics.
I think you're one of the few people who might understand what a CDO is.
And I basically said, somebody showed me a quote the other day. I basically said, look, I should understand some of this stuff, but some of the complexities of some of the instruments that are going into CDOs bewilders me. I don't understand what they're doing, or I don't understand how they're actually getting the types of returns out of the mezzanines and the various different tranches of those CDOs that they do. Now, I wasn't saying that they're wrong. I just said, I don't understand it. And I figured if I didn't understand it, and I had access to a couple hundred PhDs, how the rest of the world is going to understand that sort of bewildered me. But here I'm observing all of these very sophisticated investors trying to buy more of that stuff than existed. I mean, you remember how liquid those markets were?
Yes, but this goes to my original point, my question to you. If Alan Greenspan can't understand exactly how they're getting to where they're getting on these particular structured products, then how are any of these investors supposed to understand?
Well, we learned the answer to that.
They didn't.
They didn't. They didn't read the fine print, because had they read it, they still wouldn't have gotten it.
We've looked at some of the prospectuses for CDOs and the like, and something that is really interesting to note is HPA, house price appreciation, home price appreciation. In the worst case scenario, in terms of testing the CDO, HPA was flat. None of these investment banks, none of the investors ever asked, what happens if home prices actually start to go down?
Well, this is the basic problem of the whole risk management system. The mathematics of it and the economics of it are very sophisticated and very clever. In other words, it's based on a very fundamental principle that diversification of risk actually lowers real rates of return. The trouble, unfortunately, is with this huge mathematical infrastructure that they built up, they fitted the data basically to a period of economic expansion. And as I point out in my book and in the epilogue to the paperback, that the whole application of this very sophisticated mathematics was applied to very fragile data. And indeed, rather than trying to look at the cases where problems would arise, as I put it, not periods of euphoria, but periods of fear, the coefficients that you will get in that period of fear would have told them that the degree of leverage they were taking was very risky. The problem was in the data, not in the basic mathematics of it. And I must tell you, I mean, I have always been of the presumption, having served for 10 years on the J.P. Morgan board, and observing the extraordinary insight of some of the loan officers about basically their counterparties. They knew far more than we at the Fed knew about Merrill Lynch, Citi, or everybody else. And we, of necessity, chose to take counterparty surveillance as a very critical factor in the way supervision and regulation had to function.
But to this point, in the epilogue to your book, you say, I was appalled and shaken when the financial system failed to protect itself more effectively against a euphoric boom. Those very people you're talking about ultimately failed to do what you would have expected them to.
They failed their shareholders. And my 10-year experience was that the one thing that whole risk management system did in Morgan and all of the other banks at the time was, how does one take a risk structure that maximizes the risk-adjusted rate of return of the system? And I thought that was as sophisticated an operation as I'd seen. And indeed, what failed was, in effect, that the shareholders of the banks were not being protected, and that came as a big shock to me.
The shareholders are not being protected because the managements of these institutions, most of the large financial institutions in this country, nobody seemed to want to say, whoa, stop. Everybody wanted to get in on the dance. Nobody was willing to step back and say, you know what, this is going to end badly.
Yeah, that's true. And there's a very good reason for that. It's not that they weren't aware that the risks were there. And I spoke to them. I said, look, yield spreads are at extraordinary levels. As I point out in my book, there's one I loved, which is triple C decline, and triple C bonds, which went from 2,400 basis points spread down to 400.
Unbelievable.
Precisely.
As you said, the underpricing of risk was just extraordinary.
It was extraordinary. Everyone was aware of it. But what they all recognized is if they didn't participate, or as Chuck Prince of Citigroup said, if they don't participate and dance on the floor, they will irretrievably lose market share. And so you could very well be a highly sophisticated investor and indeed observe, as I did in 1996, that there was irrational exuberance going on. The trouble with that is that if you acted in 1996 on that concern, and believe me, it was there. I remember Bob Rubin and I used to talk about this stuff was getting a little bit dicey.
I remember covering it, and yet we had four more years.
And that's precisely the issue is. It wasn't that all of these people were caught by surprise. They were caught in a terrible dilemma. That yes, they could protect their shareholders, and they could be sitting there for years with a good balance sheet, but their status in the marketplace would be going down, down, and down, and the capitalization value of their stock would have been
missing out on a huge revenue opportunity, which securitization became for all of these Wall Street firms.
Absolutely. So there was this extraordinary dilemma. It's a more sophisticated problem than we realized. It wasn't that these people were dumb. They knew precisely what was going on. They also had seen too much history of these periods of particularly significant underpricing of risk go on for year after year after year. The vast majority of them thought that they knew when to get out. But what they found is that the market turned overnight. On August the 9th of 2007, you had a turn which was unimaginable 24 hours earlier. You had this flood of people seeking to get the weakest tranches of the CDOs, and it wasn't necessarily the next night, but as the weeks went on, that liquidity, which seemed insatiable, just dried up completely.
Stan O'Neill made decisions ultimately that have lost Merrill Lynch more money than I believe it may have ever made in its history as a public company. Citigroup, $30, $40 billion in write-downs. UBS, not an American bank. You go on and on. Bear Stearns, of course, gone. Lehman Brothers. These were not poor decisions. These were the worst decisions that financial executives have ever made. Has it changed your view of the way these things work, ultimately? I mean, you seem to have been relying on the good judgment of the managements to say, we're going to step out now. But nobody, or very few, actually did that. Everybody wanted to be in the dance. Everything seems to be about short-term reward now. The average stock is held by a mutual fund for 9 months. Everybody wants to get paid today. Is the construct no longer operative?
It is replicating history, which occurs in one form or another very similar to that, generation after generation. I mean, you go back and you look at the earlier periods of bubbles. You take a look at the 1920s. I mean, I remember back in the 50s, we always used to think about this extraordinary period of speculation and what we now would call short-termism, where basically, allegedly, Baruch decided to get out of the stock market because he was getting tips from a shoeshine boy. That's precisely what we have in a high-tech field. The psychology is identical. It's human nature replicating itself time and time again. We have no way to avoid it. In other words, there's no learning curve in this. This is not going to happen again for a very long period of time.
You said this is a once-in-a-century.
It's the type of once-in-a-century occurrence. That doesn't mean it can't happen in 50 years. But the one thing that I'm almost certain of is that we will not be involved in this sort of problem for a long period of time. And we weren't after the 29 crash for a long period of time. And we weren't after the 1907 crash for a long period of time. In short, these things crop up periodically, and as I try to point out in my book, these types of events are unforecastable. That is, anticipated crises get arbitraged away in the financial markets.
So, to those who say, obviously your legacy as Fed chairman, you are hailed as the greatest Fed chairman, but your legacy in this last year certainly has come under some attack, and you've been defending yourself vigorously. To those who would say Alan Greenspan ultimately fostered this bubble and could have done something. Fed Chairman Martin famously said many years ago, the Fed's job is to take the punch bowl away just as the party is getting good. Dr. Greenspan did not do that. We could have prevented a lot of the carnage that we've seen.
It's a credible hypothesis. The trouble is that the evidence is fragile to non-existent. The underlying argument requires an expansion of credit that goes on. And through all this period, the money supply barely grew. We grew at 5%. The monetary base, those M2, were not growing. But the far more important issue here is that this is not an American problem. This is fundamentally a global problem, because remember, there are more than 24 housing booms that occurs almost exactly the same time that the American housing boom begins. And indeed, they've all peaked at the same time, and the fundamental reason is that it's been real long-term interest rates which came down. And indeed, in 2006, for the first time in history, not only did all the developed nations have inflation rates and long-term interest rates in single digit, but the vast proportion of developing nations as well. That has never happened before. What this essentially did was to create a worldwide boom in asset prices more generally, but very specifically in the real estate area. And so that the question of the presumption of the role of the Federal Reserve is, if you look at it analytically, is really very questionable. In other words, we were being drawn into the problem that the huge globalization that was occurring and reached more than $100 trillion of arbitrageable assets was swamping the central banks.
So you're essentially saying there's nothing the Fed could have done.
To prevent the bubble?
Correct.
Yes, we could have. We could have basically clamped down on the American economy, generated a 10% unemployment rate, and I will guarantee we would not have had a housing boom stock market boom or indeed a particularly good economy either. Remember that a necessary condition for these types of booms is a sense of general underlying confidence or euphoria, low interest rates, low long-term interest rates, and essentially a availability of credit coming essentially from the securitization, not from the securitization, but from the intermediation of these huge capital gains on stocks and other assets on a worldwide basis. Could central banks have prevented it? Yes. Could they do it with short-term interest rates only? I doubt it. In other words, you have to break down the expectation of the long-term flow of income from assets to bring asset prices down. And I don't think there was any individual central bank in the world who had the political support to do what would have been required. In other words, had we attempted to really put the clamp on, which is dubious as to whether it would work in any event, I could assure you the whole question of Federal Reserve independence would have surfaced.
Right.
It's Federal Reserve
palatable to the electorate at large.
Federal Reserve independence is not carved in stone.
To the point that you've made a number of times that the rest of the world was having a housing boom, I want to get you to respond to something Stephen Roche, a longtime economist at Morgan Stanley, recently wrote about that point. He says the trouble with America's housing bubble was never its comparison with the rest of the world. The core of the problem lies in the distortions that asset bubbles created on the real side of the U.S. economy. Courtesy of the most rapid rates of sustained U.S. house price appreciation in the modern post-World War II era, along with innovative financing techniques that allowed American homeowners to extract equity with ease from their humble abodes, the new age of the asset-dependent consumer was born. Net equity extraction from residential property, ironically derived from a statistical framework developed by Alan Greenspan himself, surged from nearly 3 to nearly 9% of disposable personal income in the first half of this decade.
Why is that a contradiction to what I said?
I think his point is that at the end of the day, we were having enormous inflation in asset prices, namely in homes, and
that's accurate, but that's
the Fed should have acted on that.
But the question is, let's go back and say, what could we have done to prevent it? First of all,
well, you said you could have. You could have wrecked the economy, is what you essentially said.
It is a worldwide phenomenon that basically it's going on everywhere, and when you see that, you look for a common cause, and the common cause was the decline in real global long-term interest rates. Now, was there something the Fed could have done? Even in retrospect, I say nothing that I could have seen short of undermining the flow of profits which was supporting the stock market, or the flow of revenues that is supporting the housing market.
Frankly, when you would have had to have done it, you said you weren't aware that subprime certainly would become the problem it ultimately proved to be.
That's true, but even were we aware at the time, it's not terribly clear what we could do, basically because the central bank, starting probably in 2002, had lost control over interest rates with maturities in excess of 5 years. And remember, unless and until we could control the mortgage rate, which would have suppressed it, there was nothing fundamentally that could have been done that would have been effective.
This bubble was going to happen regardless.
Well, the question is, you've got the following problem. You've got long-term interest rates falling. You've got mortgage rates falling around the world. You've got expansion in prices moving up virtually everywhere, and indeed, the rise in prices in the United States was not above the average. There were many other countries with far higher rates of expansion than we. And so what we're dealing with is essentially a global issue over which central banks had, by the year 2002, lost virtually all control. Remember, the conundrum that I was concerned about in 2004, we had every time we raised rates in the post-World War II period, the long-term rate would move with us, the mortgage rates would move with us, and that's the reason why everyone's analysis based on history argued that the short-term rate was a key factor in the housing price and the housing boom. The truth of the matter is it was the tie between short-term rates and long-term rates which existed in the post-World War II period, but it was the long-term rates which created these price patterns in all sorts of assets. But that tie was broken, and it's now clearly broken, which meant that the ability of any central bank, and I don't want to go to speak for the Bank of England or for the ECB or others, but I know they're all experiencing very much the same patterns that we saw. So that it may very well have been interesting to try to constrain credit in the United States, and we could have. But in order to do it enough to break the back of what was a global phenomenon, I hesitate to think of how much contraction we would have to induce in the American economy to get that, and in the end would have turned out to probably been worse off than we are even now.
One more thing from Roche here. What Greenspan missed repeatedly over the years and still misses today are the corrosive impacts this bubble had in fostering the imbalances and excesses of an asset-dependent U.S. economy.
That is a statement which is applicable to the world as a whole. The question is, what are the facts? Let me say this more generally. I think it is important to find out what went wrong in problems, and when it's relevant, who is at fault, and to determine whether or not that requires action. My problem with a good deal of the postmortem on this particular problem that we are merging into, which is not over by any means, is that the diagnosis is wrong. And if the diagnosis is wrong, the reforms that will evolve as a consequence of that have got to be counterproductive.
You mentioned lessons and our ability to try and understand this crisis so we can prevent it. In the reporting that we've done over the last year, in talking to the people who took out the mortgages and the people who lent them the money and the people who structured the securities ultimately that were sold to the investors, it doesn't seem that anybody ever raised their hand and said, wait a second. Lending money, for example, to somebody, a strawberry picker, who says they earn $20,000 a month is probably not the best thing. Or lending money to somebody who has no assets, no verified income, 95% or 100% loan to value, probably not a probably not a good decision. The Fed's role as a regulator has also come up here. And I want to get your response to those who say, if anyone along this way would have raised their hand and said, guys, at the banks, you're doing the wrong thing. At the lenders, you're doing the wrong thing. Maybe we could have averted this crisis.
The problem that we have is that there is a presumption that regulation somehow works. Now, the truth of the matter is that I've been a regulator for almost 20 years, and the evidence of what we accomplish is fairly good in certain areas, poor in others. I say in my book, I think that prosecution of fraud is required at a much higher level than we are doing it. But the type of supervision and regulation practiced by banking regulators is not the law enforcement type of skills that are required for the system. In short, you need to suppress fraud in all different areas, and most of what has been going wrong in the supervision area isn't the issue of fraud where we have adequate statutes. Fraud is theft. And the question is, why don't we basically apply the law much more broadly. And the answer is you cannot do it with the existing form of supervision regulation, the laws and the practices that now exist. We are very good at making sure that accounts balance, that loan loss ratios are properly calculated and the like. Where the problems here arose essentially in the subprime area, I don't believe that existing banking premises could do it. Everyone talks in terms of we will do more and the like. I've heard that so many times over the years, and the question is, nothing happens. And the reason nothing happens is they've diagnosed the problem incorrectly. It's fundamentally in a very simple area. There is egregious fraud, there is egregious practice, and one doesn't need new supervision and regulation. What one needs is law enforcement. And to the extent that we were able to do that at the Federal Reserve, we made some progress, but the number of actual cases which we turned over to the Justice Department for prosecution, which we unearthed in our examination processes, was a very, very small number.
But why not have used your bully pulpit as the Fed chairman or the regulations that were available to you at the Federal Reserve to crack down on some of the subprime lenders in particular? A whole host of them in California who were not applying any sort of standards, for example, in what they were doing.
Could you explain to me what a speech by the chairman of the Federal Reserve Board would have done to the actions of those people? I will listen to you. If you're going to try to convince me that that would have had a significant effect, I would challenge you very strongly, because the bully pulpit is not what it seems to be. I was given the general view, well, I had very significant power. Do you realize how often I appeared before the Congress complaining about the budget deficit, the problems that emerged in Medicare? Absolutely. It's a very selective choice of what the power of the word.
So those who sit here now and in retrospect say Alan Greenspan really could have done a lot more in terms of speaking out, or in terms of getting down and dirty and sending examiners into some of these operations that were ultimately creating the subprime mortgages that led to this collapse.
I will tell you, there's a famous episode in which Ned Gramlich, the late and very effective governor of the Federal Reserve Board, came in and mentioned to me that there was a lot of these egregious practices going on, and he said, you know, maybe we should try to do something. And I said, I'd be delighted, but I cannot see any way of our succeeding, because unless we got in there with real law enforcement capability, which we did not have, they would basically put in their windows supervised by the Federal Reserve System. And then they would have been far more egregious in their actions and basically doing far more damage than I think they currently do.
So you believed that by the act of actually regulating them in some fashion, they would have taken it as a seal of approval that would have only engendered even more business?
That's been my experience over the years, unless we could really do something. Now look, this wasn't an issue that was not discussed. Remember, I mean, Ned was chairman of a board committee on this area. He was very knowledgeable in what was going on. We had a whole community development division, which was as acutely aware as anybody. The issue of what could effectively have been done was extremely narrow under then existing law. Had we tried to suppress the expansion of the subprime market, do you think that would have gone over very well with the Congress, when it looked as though we were dealing with a major increase in home ownership, which is of unquestioned value to the society? Would we have been able to do that? I doubt it.
So ultimately, what I hear you saying is that in terms of interest rates and the actions you took as Fed chairman to lower them, and their impact on mortgage rates, it was a global market. Ultimately, they were going to do what they were going to do in some ways in terms of the ability of people to borrow. And on the regulatory front, it simply was not something that was going to in any way have had a positive impact. I mean, this bubble would have had, there was nothing you could do, is what I hear you saying, about having stopped this bubble without, as you've already said, crushing the economy.
Yeah, that's what the historic evidence, generation after generation, unequivocally stipulates. I know it goes against the grain of everybody who seems to think you can push buttons here and there. It just doesn't work. What you've got to do is to recognize what these types of things are, and at root, where we can do something is in the fraud area. And our inability to do that is basically we just did not have the proper structure. We didn't have the statutes which would enable us to do that. And in the end, I'm not sure how well you could do. In other words, it's one thing to say, go regulate. But remember, the ultimate of regulation is a centrally planned economy, which everything is constrained. You can't do anything without getting permission. And these systems collapse. So there's a fundamental choice that America and everybody else has got to make. You either live with this increasingly global environment where essentially control over events is largely automatic but reflecting the values of the society. It has taken us from the early part of the 18th century to standards of living absolutely unheard of. But there are many flaws in the system, and the flaws in human nature are such that we cannot change them.
Well, let me ask you specifically about one flaw in human nature, which has been an overriding theme in all the interviews that we've done with the people who participated in this event, so to speak, and that is greed. From the homeowner who knew they couldn't really afford to pay this mortgage back, but wanted that house, to the lender who was simply making them a loan. They knew it would immediately get packaged and sold to an investment bank and therefore was taking a fee, even though they knew this person wasn't going to pay it back. To the investment banker that was structuring a product that they knew was highly levered and potentially even toxic. To the rating agency that knew it was overmatched but threw a AAA rating on it anyway. To the investor who saw higher yield versus treasuries and didn't ask any questions because they were willing to take it. Greed runs through this.
Absolutely. And you're going to pass legislation which is going to outlaw that. Try it. This is one of the most extraordinary things about this whole episode. Looking at the way we all behaved, and it's a collective activity around the world, how is it possible that this species built up such an extraordinary world standard of living, which has drawn hundreds of millions of people out of poverty? It's increased life expectancy inordinately. It's expanded the society and its underlying cultural values in ways we would never have anticipated. It's a system which produces remarkable results. We tried on many occasions to say, well, we could do it better by regulating it, by tying it down, by making government function the way in which would improve it immensely. There is no instance in which that essentially developed into something which was positive. I know of no episodes in which freeing up economies, increasing individual rights, increasing the rule of law, which is essentially the role of markets, that didn't enhance economic well-being.
You still firmly believe the power of free markets?
I firmly believe that because I know of nothing in the evidence of the alternatives.
Fully acknowledging the bad things that
go on? In fact, I go at great length in my book expressing concerns about the flawed nature of the species, so to speak. And I think the thing we should be remarkably, I would say, the thing we should be most extraordinarily appreciative of is how far this system has carried us. Because there is no doubt that somewhere in the future we're going to have this conversation again. It will not be for quite a period of time, but it will occur because the species has no learning curve with respect to issues of greed and other aspects. The only way to eliminate greed is to eliminate the capability of practicing it. The only way you can eliminate the practice of greed is to essentially clamp down on all innovation, all economic activity in a manner which people cannot move. And we saw what happened behind the Iron Curtain for a long period of time. It doesn't work.
I'm hearing echoes of Michael Douglas from Wall Street. You know the quote, greed is good.
Greed is not good. Greed, unfortunately, is a negative aspect of human nature. Its positive side is what greed in a lesser form is, namely a desire to enhance one's well-being, standards of living, and that's what...
But you still have faith in these risk managers who let greed get in the way of their better judgment.
My question essentially is, these are the most experienced technical people that there are. What would we replace them with? I mean, I say in my book, basically, if a physician misdiagnoses your illness, you don't ask the patient for a better diagnosis or a guy in the street for a better diagnosis. You say to the physician, go back and get it right. And what I'm saying to risk managers is go back and get it right. The problem here is that there are many things government can and should do. And as I say, fundamental in the regulatory area is fraud. In the supervisory regulatory area is to get the risk management issues correct. A lot of the other stuff which seems to be productive is not, and is actually counterproductive. And I think it's terribly important, as I said before, that misdiagnosing the cause of the problems we've been through and have yet to fully get out of is going to create types of situations which in the long run will lower the standard of living of the American people, not enhance it. And the purpose of government should be to put in place those types of conditions which enhance it. Merely saying government should act to do this, that, and the other thing is all well and good, but if it doesn't work, and history is very clear on this question, it doesn't. In other words, we have continuously backed away from central planning, which is the fundamentally end result of the argument that if the government can supervise and regulate and effectively do so, why not continue going on, which is the ultimate in central planning, which indeed is precisely what societies did, and then abandoned it, recognizing it didn't work.
A couple of final questions. Do you still have faith in securitization and in derivatives, which, as you've said, so largely magnified and really in many ways created this catastrophe?
Look, the issue of credit default swaps, because it's a critical statistic. They remember to do an extraordinarily important job, which is to deal with highly leveraged institutions which make loans and to lay off the risk, essentially, to those who are more capable, have larger capital to absorb the risk and are willing to do that at a price. These have been very effective. But with all such instruments, you have greed coming into position, and you've got
a highly unregulated market in which, again, it made perfect sense, insure against default. But more credit default swaps have been written on more things. I mean,
well, remember, the real problem of credit default swaps is basically that the actual number of outstanding swaps far exceeds the instruments which they're protecting. And while there's cash settlement, it is not legally mandated. That is done on a voluntary basis, and I've argued, and I do indeed in...
You've said it's a 21st century product based on a 20th century, I believe.
The 19th century telephone
and pencil. Right.
But what has to be done there is, one, to clarify the issue that you can settle credit default swaps with cash, and that you've got to get infrastructure in place in which the buyers and sellers of these instruments are actually did agree on something which they're all is written down and is legal and official.
But you're still a believer in...
Oh, absolutely. And securitization, credit default swaps are all very positive instruments, but like all such things, it's very easy to abuse them. But they have served a major purpose in creating increased financial productivity, because remember, the basic purpose of finance is to effectively move the savings of a society into investment, into the most productive investment, meaning that investment for which the physical productivity is at a maximum, which means finance is there for the purpose of enhancing real standards of living of a populace. And to get it right and innovative and sophisticated is a very major contributor to standards of living in our society. And not to recognize the fact that there are great benefits. This is not just merely an issue of a bunch of people making lots of money, doing very dubious things, but the system as a whole has basically been very effective in increasing the efficiency of the system, where a country like the United States, whose savings is not very high, even including the amount of savings we borrow from abroad, we nonetheless, because of our very effective financial system, have over the years increased real productivity in the economy, because we focus the movement of assets towards those most effective in raising productivity, which of course is the base of standards of living. So finance is very important to be innovative, progressive, advance, and there were huge numbers of practices, like all innovations, which fail. We will never see them again.
We will never see the likes of a CDO squared again, I would imagine.
I cannot imagine. And the reason, essentially, is there are no investors who are willing to invest in them. If there's no one there to invest in them, game is over. There's nothing to regulate. There's nothing there. And a substantial part of what's gone on very recently is to eliminate a very large part of what was innovative, thought to be productive, and wasn't.
Did you ever believe that housing prices in many of the major markets in the United States would decline 30 to 40% from their highs?
No, for one fundamental reason, is that there has always been an uptrend in home prices in the United States, largely because we don't have very much productivity in housing, because we customize our houses, which is the anathema to productivity growth. And the history of home prices in the United States is that they go down very, very rarely, and indeed that's true around the world. So while I would often think of, copper prices could, drop by 50%, largely because it's a single market, but because of the fact that housing markets cannot arbitrage. You can't arbitrage Portland, Maine and Portland, Oregon. That these markets were far more rigid and less flexible. And even though we at the Fed were watching the rate of home price rise relative to owner's equivalent rent, which is that price index in the consumer price index, which is essentially a proxy for the rate of return on homes. We were seeing ever-increasing price-earnings ratios. So we were aware of the fact of what was occurring. But the presumption of a significant decline in home prices was not only something that the Federal Reserve staff and everyone else didn't believe was going to happen, but as you pointed out, neither did a lot of the managers who were setting up various different types of products in which home prices were a critical variable. You go through 50, 60 years of experience with virtually no declines, and you somehow believe that that's the norm, and it is, except for the crisis that happens once in a century or half-century.
Leverage played such a large role in this collapse, essentially. Leverage in CDOs, leverage in home prices. Did you think through what was going on at so many of these banks, which is the CEO would say to the guy who ran structured products, and we've talked to these people, I need you to generate more product. And that guy would say, well, I need more leverage to do it. And they would say, fine, because our money is basically free.
The issue of capital, which is the obverse of leverage, has always been on the table. And indeed, I recall that my earliest questions when I arrived at the board is, why is 10% the right level of capital in the banks? It was 40% in 1870. And the arguments came back that over the years they have developed capital standards which certain things were well qualified. Remember that before the crisis began, the banking system was more highly capitalized and perceived to be in a much safer position than any time in recent history.
The 1991 period was not a great period for the banking system.
No, I'm trying to say, I'm talking about the period
right
just prior to...
05 or so, you're talking about?
Well then too, but up until 07.
So that 15-year period, it was...
Well, remember that...
banks had recapitalized themselves very significantly through the 1990s and the first half of 2000.
The problem of what we're going to find ourselves looking at is my question got answered by the market. That 10% is not the really desirable level over the longer run for capital. As I pointed out, and I think this one was in 2000, that the commercial banks basically endeavor to eliminate, as far as they see it, all risks that would occur except maybe once every 50 or 100 years. And that their view is basically they should not have capital which would protect against that, because were they were required to do that, they would be in an extraordinarily difficult position holding capital that is required only once in a century. Now, the problem basically that we confront at this particular stage is that the markets are telling us by the fact that, for example, we could say that general lending rates of banks, LIBOR, for example, relative to what is called overnight index swaps, is reflecting a degree of risk, solvency risk in the banking system, which is requiring far more than 10%. And the economic capital that is now required in the marketplace is vastly higher than anything we've seen in a long period of time. And the only way we are going to get these abnormal spreads down to where they were prior to the crisis is by building up capital. And essentially, the private markets, private investors are saying that unless the banks have this capital, I don't want to hold your liabilities. And so we're going to find over the years that bank capital requirements are going to rise inordinately. Basel II, which was an international agreement, is going to be significantly revised. And we're going to find that as a result of this episode, for a while at least, markets are going to require much higher levels of capital.
In all transactions
In all
as well.
transactions.
Because to the point, leverage, of course, became incredibly widespread at incredible ratios.
Yes.
From leveraged buyout deals, which I covered closely in terms of what private equity was able to do, to the structuring of CDOs that were extraordinarily levered vehicles in all ways, in part because money was so cheap. I mean, a Fed funds rate at 1% for, over a year, the banks were willing to take risks that they might not ordinarily have done.
Well, remember, it's not the banks that are banks are the most heavily regulated part of our financial system.
They're willing to finance deals at the leverage ratio of 6 times.
Let me put it to you this way. We were very cautious at the Federal Reserve in bank lending to hedge funds. And we were raising the issue at innumerable occasions. The hedge funds were not a problem here.
No.
And the reason they were not a problem was everyone was concerned that they would be a problem. The problem was arbitraged away. What one has to confront on the issue of regulation is, why is it that the most highly regulated part of the economic system is the one that failed?
Oh, boy, we can make that a conversation for another day.
And the clear answer, as far as I'm concerned, rather long, but I hope to the point, is we have to find a way to simmer down the extent of activism that is currently going on and allow this economy to heal. That is a very minority view in this country. I will argue that we have to let the facts show what they do. And I'm not saying that the stimulus is not working. I'm just saying it's working far less than anyone anticipates. And you can explain the shortfall in economic activity from what we would otherwise expect it to be strictly by that relationship.
Improvement in the housing market. How do you anticipate that housing market, which has continued to plummet, where there are now 8 million homes where the equity is 5% or less, there are 12 million homes where the mortgages exceed the value of the equity. How do we and there has been, in a sense, an unbelievably limited response in terms of housing to the lowest interest rates. The first time that when interest rates have gone down, that housing sales have also gone down. And when you multiply housing prices by the finance, it takes up roughly 15% of family income compared to the conventional standard of 25%, which people have felt they could afford. How do you deal with that particular issue of the economy, for example, if you're going to have that as a condition to a turnaround?
Mort, that's a very important issue, and I would say a necessary condition that we recover out of this without too much further damage is that home prices do not take a dip downward. First, I think it's important to go back and ask ourselves, well, what's causing the inability of all of the government programs to work? I mean, no matter how you look at even with the 8% subsidy on new home purchases, it didn't increase the net amount. I mean, it moved purchases up front, but remember that you cannot get an increase in housing unless you either get an increase in household formation or you get an increase in conversions, or I should say a decrease in conversions, or an increase in demolitions. In other words, there are a certain number of people in the society which must be housed. They'll either be in rentals or they'll be in homes. And you can move things around all you want. You're not going to avoid that particular requirement. And what the data show is, after a dramatic rise in home ownership, in which 100% of household formation went into owner-occupied homes, mainly single-family, which of course is the cause of the huge boom in construction. That stopped about 2005, 2006, and has since gone into reverse. So that we're actually losing the number of homeowners, and as a consequence, we're getting housing starts for single-family dwellings down to unbelievable levels. It's 500,000 annual rate, which is barely the amount of demolitions that go on in the country. I think that until we unload the very large amount of single-family homes for sale which are vacant, these are largely held by investors. And fortunately for us, there is no evidence that they're trying to unload these, because were they to do that, prices would be under real downward pressure. But they're not doing that, but nonetheless, there's this big overhang of unsold homes on the market. And until we absorb that, there's no real solution to the recovery. And the way you absorb it, basically, is very low construction levels. In fact, the lower the better, statistically. And allow the normal increase in the labor force and therefore in household formation to absorb the excess. That's actually going on. I mean, it's not as though we're stagnant. We are reducing this overhang, but it's going to take a year or so to get rid of it. I thought we'd be able to get rid of it a lot faster than we are doing it.
Well, even a year seems to be optimistic given the amount of supply available on the house and the shadow inventory.
Yeah, I agree with that. But if you begin to get the prices continuing to stabilize, then the shadow inventory will gradually disappear, because we are beginning to see foreclosure starts, so to speak, peaking out at a very high level. But the real estate owned by the financial institutions is horrendous. And that stuff still has to feed into the market. But it's been doing that for a while, and prices have sort of stabilized where they are. And if prices can hold, and I'm not sure about that, I think they can, but a lot of forecasts say they're going down. If prices can hold, we will gradually eliminate the shadow inventory and we'll turn it around. But I agree with you, it's a very critically important issue. And as you say, a year is a long time. I'd like to raise one problem that disturbs me more than anything else. In 2005 and 2006, there was about 8 million homes purchased with so-called conventional conforming mortgages, 20% down and the like. That's a very big chunk of the housing market. The home equity of that 20% down payment is now gone.
Right.
So we've got a lot of conventional financed homes, as you put it, sitting right on the edge of going underwater. Fortunately, they don't default very quickly, but if they get there long enough, as you know far better than I, they do.
Well, there are a lot of strategic defaults, as they call it, where people are
right.
basically not paying their mortgage payments, and the lenders are not foreclosing on them because they don't want to take on the homes. They'd have to show the losses on their books, and they don't want to maintain the homes. And if you have a vacant home, the value of that home drops anywhere from 5 to 10% as soon as it's empty. But at some point, there's going to have to be some sort of moment of truth here, where you have literally several million homes in this.
Isn't it free rent?
Yeah, it's what enables them to pay down their credit card obligations, for example. And that's what's been going on. But sooner or later, there is going to be some movement on that issue. And that's one of the great vulnerabilities. The one thing, of course, that would save it would be an improvement in employment. I mean, in one sense, jobs really will help out the housing industry. And that's another area where we have seen a dramatic drop, and with virtually no response to the enormous fiscal and monetary stimulus. You can say we saved some of the jobs, but the fact is we're looking at the highest levels of unemployment and partial unemployment that we've seen really since the end of World War II, and those numbers do not seem to be getting better. So what is it that we can do, in a sense, to have that primary driver of both confidence and the ability to maintain homes and to enhance and support consumer spending? How does that change? And is it structural or is it just cyclical?
No, I think at the moment it's a little bit of both, but the critical problem here, if it's a problem, is that even as the economy was growing, employment wasn't, which is another way of saying that output per hour was increasing. But it's that very output per hour increases, the productivity increases, when you look in terms, as I mentioned before, about non-financial corporations. One of the issues here that's creating statistical concern on my part is we're getting this huge surge in corporate profits, which is the result, basically, of the improvement in productivity and the decline in unit costs. And that is not spilling over into new investment. Instead, it is showing up as a major increase in the size of liquid assets as a share of total assets in the corporate sector, the highest level in 50 years. It's essentially a reflection of the fact that the business community is extremely averse to risk of investing in long-term illiquid assets. And that is another way of saying that construction generally, as you know, is under severe contraction, basically because the higher the risk premium for long-term assets, the lower the market value of the properties. And so we're seeing that particular phenomenon basically crushing construction, and construction is the loss in construction is the largest contributor of unemployment. And if you look at the distribution of who's unemployed, what sticks out readily is the big construction worker component. And I don't think the answer to the employment issue is to slow productivity growth. It's slowing by itself, or almost normally. But the answer here is to get the economy going again, and the only way I can see we can get that is to lift this pall. Remember that we're getting all sorts of indications of what this pall is all about. For example, not only is there a contraction relative to cash flows in the issue of new fixed investment, but the nature of that investment is going increasingly to short-lived, less illiquid assets, in the sense that if you look at the ratio of equipment and software to total investment, it's going up straight away as structures haven't even turned. There's been a significant rise in capital investment in equipment and software, but in total, it's nowhere near the rise required to absorb the amount of lost investment. I'm estimating the loss at something like $400 billion, which is not a whole lot much different than some of the estimates of the stimulus.
We were building 1,600,000 units of housing. We're now building somewhere on the order of 400,000 to 500,000. Roughly 1 million homes are not being built. The employment per home was generally anywhere from 5 to 10 people working on a home. Those jobs are simply not coming back for a good while, given what's happened to housing prices. Now, that is a huge lump of unemployment that we're going to have a great deal of difficulty addressing. How does the government respond to that?
Well, my argument at this particular stage is we'd probably be better off by doing less than more. There's an implicit judgment on the part of most economists that in order to stimulate the economy, you have to do something. But I think there's another choice here, which is basically gets to that old business of when you're digging a hole, sometimes you stop digging. And my view here is that I think we'd be far better off to allow the normal market forces to operate here, because one of the things that we have going for us is that the equity premium in the financial markets is at the highest level, according to J.P. Morgan, in a half a century. In fact, it's tracking these relationships that I've mentioned before about investment and savings. You see the process of everything is 50 years, the worst in 50 years at least. If you look at the study that just came out yesterday by the National Association of Independent Businessmen, which is the small business people, their capital investment is the lowest in the history of the survey, which goes back 35 years. We've got to get that coming back, and to the extent that the evidence suggests that very large deficits do concurrently crowd out capital investment, there is a debit to the stimulus program, which is probably somewhere between a third and a half of what the gross stimulus is. And that's where the problem is, and we've got to remove that. And I would say that because we have such a high equity premium, the upside of equity prices rising is very significant. And as I've written and said for a couple of years now, the most effective fiscal stimulus we could get, or stimulus, would be if the market value of equities rose. It does remarkable things to financial institutions, and it is a very clear indicator of the impact of asset price changes on capital investment.
Well, we had a considerable increase in equities, at least in capital stocks, stock market prices. We have not had that in the housing market. And what you're suggesting, if I understand it correctly, is to be very cautious about further fiscal stimulus. I don't know why this brings to mind the definition of a bartender who is a pharmacist with a limited inventory. I mean, we really have very few options, in a sense, at this stage of the game, given what we've been through, both in fiscal policy and monetary policy, and that impulse to do something, your suggestion, could be counterproductive.
I think that what we have to do is keep an open mind on what the facts show. I mean, this is a highly politicized, sensitive issue. I mean, for example, I've been strongly in favor of closing the deficit as quickly as we can, because I think deficit problem is a much more dangerous issue. I don't think we have time to wait. So I'm coming out in favor, for the first time in my memory, of raising taxes. And the reason I'm doing that is essentially that I think that we're getting to the point at this stage that unless we come to grips with the deficit problem very quickly, that we're fooling ourselves about how much time we have. And I would love to see taxes go down, and I would hope that what we could do is, if we allow the tax cuts, the so-called Bush tax cuts, all to lapse, as they will, of course, legally on December the 31st, and then gradually bring the level of expenditures down, which is it's not a question of affordability, it's that we are committing more in the way of real resources in the public sector than we have. And unless we start to do that and then bring taxes down, or the way I put it, we should not have tax cuts with borrowed money, but we should have tax cuts. And the more, as far as I'm concerned, the better, but only in the context of bringing the deficit down, because unless we do that, I think we have very grave problems ahead. And none of the issues we're discussing this morning will get solved.
There's a widespread feeling in the business community of a lack of confidence in this administration. It really does have an effect on the decision-making process. I mean, in part, I guess, because the economic consequences of the fiscal stimulus and the monetary stimulus have been so limited. There is a sense that these issues get politicized. What would you recommend, just on the intangible level of confidence? How would you suggest an administration sort of rebuild that confidence in the business community?
Well, I think that this president can do that. I think he is very clearly highly intelligent, as best I can judge, and he understands issues. And I think that politically, obviously, it's very difficult for him to turn, but I think it's feasible. In fact, I think it's necessary.
Well, one of the issues that we have in this country is certainly that intellectual capital is at least as important as financial capital in a world of very rapidly changing technology. We have reduced the number of H-1B visas from 195,000 in the year 2000 down to 65,000 today. Now, we are sending roughly 50% of the graduate students, MAs and PhDs in the hard sciences are foreign students. Other countries are going around setting up offices around the world to recruit these people. We're sending them back to their home countries where they can compete with us, either from the countries or from companies in those countries. What should we do on something like that?
Well, I think strangely enough, going back to your previous question, one way for the president to get started would be to press very hard to, I would say, lift the H-1B and require quotas and essentially argue that anyone who gets, say, a PhD in the hard sciences gets a green card or something like that. The problem that we have is a very difficult political one, but it's not the self-evident one. It's the fact that that issue, which I think the majority of Americans, and I think the electorate, would approve of. In other words, if you don't have the skills that are coming through our educational system at home, you import them. And indeed, we've seen an extraordinary proportion of the entrepreneurs in Silicon Valley are foreign-born. The problem that we have is that they have two separate immigration problems. They really are distinct. One is the illegal immigration, heavily dominated by those with a high school, less than a high school diploma, and the H-1B heavily dominated with PhDs and advanced degrees and a wide variety of skills that we need here. These are two separate problems. Both are important. As I've argued, I'm strongly in favor of immigration. I think that, I don't know how you get the illegal immigrants out, but I bet you if we ever try to get them out, everyone would start screaming because nothing was going, all the work that they do would not happen. So I would like to see us solve that problem. But the point of the issue is that these are two separate immigration problems. We put the same name on them, they go into the same bill, and I think we have to decouple, if I may use the term everyone's using.
There is going to be a lot of pressure, political pressure, for another stimulus program. It certainly isn't a dialogue going on now between, is the employment structural or is it cyclical? Will a stimulus program help the employment issue? Martin Wolf, a well-known economics writer for the Financial Times, described the last stimulus program as basically being too small, too wasteful, and too ill-focused, so that a lot of that stimulus was not stimulating. And frankly, I think there were so many different programs put into that package, transfer payments, alternative minimum tax, things that really were not directly, specifically increasing employment. If you had a stimulus program, in a sense, almost as a political part of a package that would be political, what kind of stimulus program would you recommend?
Long-term infrastructure assets, because under current conditions, those are precisely the types of things which the free markets will not give you, because the discount rates are much too high and will remain much too high so long as there is a sense of malaise out there. So government stimulus, if it were put into the longer-term infrastructure assets, would not be displacing the private sector so much, because they're already displaced in that regard.
I know you said that you won't comment on monetary policy, Mr. Greenspan, but could you just say in general whether a central bank is out of tools to increase the velocity of money? I mean, liquidity is just theoretical if it's parked. Does a central bank have, I mean, we now pay interest rates on deposits, and your prescription seems to be fiscal and laissez-faire.
Well, let's remember what the nature of the problem that's raising the issue of quantitative easing. We have $1 trillion in depository institutions in the United States, which are so-called excess overnight reserves, deposited at the 12 Federal Reserve banks at 25 basis points. Federal Reserve data surveys show that there is available on a continuous basis, because these markets continuously turn over, commercial and industrial loans of fairly low-risk type of loans. It's a term, according to that the Fed uses, which are yielding 125 to 150 basis points above what the depository institutions can get as at the Federal Reserve. That means, of necessity, that they are foregoing that because they see credit risk. And that is an extraordinarily high risk premium for so short a time frame of a loan. And what this implies, basically, is the issue I've mentioned before, namely that there is a heavy weight of uncertainty on the system such that we are not getting the impact of the $1 trillion already on the books into the marketplace. In short, as economists like to call it, the money multiplier, because remember, when you get excess reserves in the banking system and the individual holders of those excess reserves start to re-lend them, there is a multiplier effect which is showing up usually in an increase in the money supply. And until very recently, the ratio of the money supply to the so-called monetary base, which is essentially determined by the level of excess reserves, that has been at extraordinarily low levels. In short, there's a clogging up of the system in the sense that, and this is not true, this is not only the United States, this is true pretty much throughout the developing world, the developed world, I'm sorry. And what is happening is you're getting this huge amount of flow of central bank monies into the financial system, and it's caught, it's just stuck there. It doesn't move. Keynes in 1936 described this process as a liquidity trap, and he described it exceptionally well. Until you change the psychology, until you change the attitude towards risk, you will not get this system moving. And I think once it does, then we're going to find that that $1 trillion is going to begin to work very effectively in expanding commercial bank balance sheets, which, as you know, have been very stagnant recently. We're going to find that C&I loans, which have been coming down and now just sort of bottoming, they will start to move back up. But unless and until that happens, our financial system will continue to be disabled.
Are we in the midst of a modern-day depression?
Well, I think the answer is no, and it's interesting that the answer is no, because there's still sufficient vibrancy throughout the world that we're beginning to get the notion that we're about to get a double dip. The probability of that is clearly going down. And one of the reasons is that the trigger of a double dip requires that something goes down. Well, our inventory accumulation is not at a level yet which suggests that a liquidation is going to create problems. You can't argue that we're going to get sharp declines in construction, which is usually what tips the thing down. You can't argue that motor vehicles are going to go through the floor because they're already on the floor. I mean, so that what we have going for us is that the tinder for a double dip is not readily available. Now, that doesn't mean it can't happen. If we get housing pricing down, then all bets are off.
That's the biggest risk, it seems.
That to me,
shadow inventory and the real inventory. And the shadow inventory will grow dramatically.
It has grown dramatically.
Yes. There are millions of homes where people have not made any payments on their mortgages in 2 years. And the lenders are not throwing them out because they don't know what to do with the assets. But at some point, if you get another 5 to 10% drop in housing prices, that could really just transform that whole world.
I worry about that.
Yeah.
I'm more worried about that than I am of a double dip, so to speak.
Been going on.
Well, first of all, I think that one of the issues that I raised in a Brookings paper, am I allowed to say that here?
Yeah, oh, absolutely.
Yeah.
Do you know what my name was before I changed it from Brookings? Yeah.
Okay. A Brookings paper which I wrote and has just been finally published, I raise a very interesting problem which I don't know the answer to, and that's we have seen a very dramatic rise in the share of national incomes going to finance and insurance. For example, in the United States, it was 2.3% of national income, I should say, gross product originating. In 1947, it's now up to 9%. And it raises the interesting question, is this extraordinary rise something that is required as the division of labor increases? I mean, as you get because remember, the basic purpose of finance is to direct the scarce savings of a society into the most effective, productive goods, and there is a form of creative destruction that goes on, which you basically phase out obsolescent capital in the system, and the depreciation from that capital, plus the net new savings of the community, gets invested in cutting-edge technologies with high output per hour, and that's the increase in one and the decrease in the other, which continuously creates an increase in productivity growth, standards of living, and the like. But there's this very knowing question: does that increasingly complex process require an ever higher rate of value added or income originating in finance? And it is not a U.S. phenomenon. The same trend exists in all places, China. And you can't argue that the same forces are at play. There is something that is going on which we don't fully understand, but I think we need to. And if we cut back very substantially on the extent of intermediation in the United States, I'm a little concerned that we will find ourselves in an increasingly less competitive position, but I don't know that. In other words, I know what the data show, and I know what hypotheses you can make about why it's happening, but there's no direct evidence that says that ever-increasing share of the gross domestic product going to finance is a necessary condition for increasing standards of living. And the reason basically is that this trend did not exist prior to World War II. And so there's something odd here that it requires explanation. I do think that we need more capital, because it's hard to realize this, but if we had adequate capital, remember, if you have enough capital in a financial institution, by definition, it cannot default. If it defaults, the capital is inadequate. So if you have adequate capital, you don't have defaults, you don't have contagion, you don't have any crises that emerge as a consequence of debt. And so the question that you've got to get to is the hypothetical ones. And I don't want to talk about Bear Stearns, but Bear Stearns, if they had adequate capital, would be thriving at this particular stage. And Lehman Brothers would still be, I'm seeing the two senior people of both these organizations sitting side by side here. We lost two prominent institutions in this country because they ran out of capital, because all of a sudden they decided that tangible capital of 3% was adequate for a financial intermediary, which it is not. And so we have to build this back up. I think the sooner the better, and I thought the nature of the regulations that were promulgated by the Basel Committee made sense to me. And I don't think 8 years is a real problem, because it's inconceivable to me that we can get another type of crisis of the type that we're trying to protect against in the next 8 years. We first have to go through the absolute reverse. I mean, the issue of irrational exuberance emerging in today's environment sounds like a contradiction in terms.
Pete?
To what extent are you concerned about some kind of what you might call a global debt crisis?
Well, Pete, that's a real serious problem, and I think it's most evident in the United States, where we talk as though, well, let's keep the stimulus going for the next 2 years, then we will address the problem. I find that extraordinarily risky as a notion. People have to remember what happened in 1979, as you well remember, that in the summer of 1979, a 10-year Treasury note, I think, was yielding 7 or 8%, and inflation was rising, but there was a general view that the United States was not an inflation-prone economy, and that therefore you could not get significant rises in inflation premiums embodied in long-term interest rates. Within a couple of months, the rate increased by 400 basis points. The psychology broke and the illusion broke. And I think that we have got a fiscal situation sitting out there in which, if we don't curtail it sufficiently quickly, I think we're in trouble. And I certainly will argue that if we allow the Bush tax cuts to lapse, that there are risks out there. That is unquestionably, even with the arguments I'm making, namely that there is a relationship between the deficit and the other levels of private spending, even with that, there is a risk out there that if you allow rates to rise as much as they are going to rise automatically on tax rates on December the 31st, that there are risks. But our choice is not between good and bad, it's between terrible and worse. And the issue here is we have to recognize that we cannot take the risks. I just don't visualize how we're going to get through next February's budget program, because there's no question that anybody who's looked at the data closely, as Pete I know has very, very great detail, we have essentially put on the books a level of commitment to the real resources of this economy, which I don't think we physically can meet. I'm not talking about financially, forget finance. And it's fundamentally that we do not know and we cannot forecast what the size of Medicare is going to be. And it's one of the reasons is that the technology is so extraordinary and improving so rapidly that when you put that into a fee-for-service, subsidized type of economic structure, it means that demand will get fulfilled irrespective of what it is. And if you end up with X percent of the GDP as medical expenditures, I guarantee you will find that X percent of total employment will be in the medical profession, and that means less to produce cars, less to produce agricultural products, less education, less everything else. It's real resources. You don't have to get to finance. It's just a question that we have, in this country, we are at the cutting edge of productivity growth. That means we cannot increase output per hour at a rate over a protracted period by more than 3%. At least that's what the data show. Since we know what the size of our labor force is, we know in general what the outer limits of the real resources of our productive system is capable of turning out. All I say is if you look at those comparisons, we're running out of resources, and it is reflecting itself in a gradual reduction in the cushion between the public debt held, I should say, federal debt held by the public as a share of the ultimate capacity to borrow. That is closing. It has never closed at this rate previously. The last time we were even close to it was during World War II, but then we knew that when the war ended, the demand for the military would collapse, that the deficit would disappear, and that we needn't worry about the longer term. And that's indeed exactly what happened. That's not the case today. And unless we come to grips with this issue quite soon, and Pete has devoted a huge amount of his time and resources to focusing on this issue, and I think that it's one of the few investments in this country which I think which may be working at this stage. You are an intervener, as I was for a while. The way we used to intervene was to wait until a particular currency was net short. Then we'd go in and we'd look very smart. But it was never a permanent sort of issue. Japan is a very different issue, because remember that the reason the yen is as strong as it is, the reason why you can sell JGBs for 10 years under 1% is that there is this extraordinary yen bias in Japan, where, as you know, nobody holds JGBs outside of Japan except in index funds. And the reason essentially is that the demand for yen issues domestically by Japanese is so strong that it keeps the interest rates low, it keeps the exchange rates strong, but I don't think it has a very significant international effect, largely because there is still heavy arbitrage going on between all the currencies, and there is a Japanese problem. And the Japanese problem that's going to emerge is not there yet, which is essentially when the population ages sufficiently such that their consumption rises relative to savings, and eventually their current account surpluses turn negative. At that point, they're going to start to have to borrow in the international markets at very much higher rates. That's where the real problem, I think, of the Japanese fund problems exist. And we're not there yet. We still got a way to go. But it's something which you ought to be wary of, because it's going to happen. Well, first of all, let me just say that as one of the things I discussed in this Brookings paper is that central bankers for the last decade or so have been aware of the possibility of the type of crisis which eventually happened. We hadn't a clue when it might happen, but that it was theoretically possible was there. And as I pointed out in that piece, and as I wrote, as I made a speech actually a decade ago, when that happens, you find that there is no alternative but to substitute sovereign credit for private credit to keep the financial system and intermediation going, which is a necessary condition to keep the economy going. So I was very strongly in favor of, quote, the bailout, because I think the TARP actually was very effective in maintaining a degree of intermediation which we would not have had. And the Fed supporting the commercial paper market and money market mutual funds These were all crucial actions to stabilize what is essentially a once in a 100-year, as I put it, once in a 100-year flood. And you have to do that, and I think it worked, and I think it was very useful. I think to extend beyond that is certainly, in retrospect, not been a very useful endeavor.
Well, thank you on behalf of everybody, as always.